Hey everybody, Josh Lurie, Principal with F Street, and we have our Development Associate Lane Guger here today. Thank you everyone for joining the roundtable. We're excited to chat with you about a current deal that we're really excited about in funding and multifamily development in West Allis, Access Apartments. So we're going to kind of keep this brief today, highlight multifamily development as a whole, the multifamily asset class, and then dive into our project and why we're really excited for this investment opportunity, development opportunity. So thank you for joining us. So just a little bit about F Street in case you have not been on the roundtable series. We're an alternative real estate investment firm. We are focused on the investor and building long-term wealth and passive income for our investor. And what we like to say is we like to plant money trees and find compelling investment opportunities traditionally or predominantly in the multifamily and industrial asset classes via acquisition, value add acquisition, or ground up development. Just a quick slide about our company. We're manage about $700 million of assets in our current portfolio, which will be growing after 2 closings later this month. We were founded in 2009. We're a fully vertically integrated real estate investment company. You can see our team here. We do outsource property management on the multifamily side. We're investor focused. We have assets in 10 states and growing. And as I mentioned, predominantly focused in 2 asset classes, multifamily and industrial.
Yeah, so just real quick, here are a few of the active development projects we have going right now. We have F Street West Bend, LLC, 105 units under construction. Move-in started in March. It's garden style, so we're phasing buildings as we go. Village 43 in Brown Deer. It's our second installment of apartments in Brown Deer. 156 units. It's under construction. Move-in started in May 25 and will be phased over the next couple of months. And then we have Summit, which is F Street, OCLV, MF2, and MF3 in Oak Creek. So that's the first phase is 75 units, second phase 25. The first completion of the first phase will be in December of this year, with May of next year delivering 57 units in phase 2.
Yeah, so across these 3 projects, we've raised $35 million of equity, all have TIFs, right, which we'll get into a little bit about our multifamily development process here at F Street and setting up favorable economic structures with tax incentives. So a little bit about why we love multifamily as a whole. Lane, want to just touch on that and why we're investing in the multifamily asset class?
Yeah, for sure. I mean, there's a lot of great things about multifamily, and there's a lot of great things to be said about industrial too, but they're different. They're different investments, right? So with multifamily, you have rents that adjust with inflation, right? You don't just have one tenant with one lease where they're maybe increasing by 1% per year. With multifamily, you have a lot of tenants that have leases that likely expire on a year-to-year basis. So you, as a landlord, can keep your rents in check with inflation. So that's a huge thing for multifamily. Aside from this, which goes along with our industrial investments as well, is it's a hard asset preservation. We talk about it's great to invest in alts for many reasons, but one of those reasons is it's a physical asset, right? And then the other thing is it's an essential need. It's a stable demand. And as house prices continue to go up as time goes on, the substitute is renting. And we believe that there will still be a strong renters market, especially in the Midwest, in Milwaukee specifically for years to come.
Yeah, and just a couple of quick other touch points, Peter, if you just want to flip back. With student debt, with people delaying, get into their careers, a lot of times going to grad school. People are looking for flexibility, optionality in terms of renting later. People are starting families later. People are looking to rent longer. So as a whole, the rental market continues to remain strong in our local market and across the country. And we'll you can flip the slide now, Peter. So specifically, right, we talk about multifamily acquisitions, right? We talk about multifamily development. And the question is, why does F Street, why are we so bullish, or why are we excited about developing our projects? And a few of those reasons are, when we're developing, we really have control or maintain control over the overall economic package that we're raising capital off of to you, the investor. And we do this by the way of putting together a project with our design build architect and our contracting team to deliver a product from a cost basis that's efficient, still a quality product, but an efficient cost basis. And we're also able to put together a incentive package with the city via the way of TIF incentives to help us boost returns. And then we're also we're building year one net operating income over our development costs above a 7% yield on cost. Now, when we go to look at the market and we're trying to evaluate opportunities to buy multifamily, they're really challenging to buy above a 6 to a 6.5 cap rate. So because of the incentive package and because of the overall economic package we're putting together via the TIF and the product type, we're able to deliver, for example, in this product, an above 7% yield on cost, right? And this particular project, it's 7.5%. And we know where the market is trading and the comps are trading in multifamily investment sales, which are below 6%. So day one, we're creating economic spread, right? In a way that's stronger than just buying a multifamily asset. And then our process here with our 11-person team, going through ways to mitigate risk across our development process, right? And we can talk a little bit about underwriting conservatively, right? We can talk about our process with our total project team and then how we manage our real estate and eventually try to maximize proceeds on an eventual sale. So we'll get into more of that.
Yep. So as Josh mentioned, we have investment criteria to make sure we're not just putting any old investment in front of our investor base. So as simple as it gets, we want it to be financially viable for you. So deal metrics, we're looking for IRRs from 18 to 25% or higher if available. Equity multiples, which is your cash invested, your total returns divided by your cash invested. So 175 is a great target for us. That means if you invest $100,000, we hope to distribute to $175,000 over the whole period of investment. And then an untrended yield on cost of 7% plus. So yield on cost, the formula for this is net operating income divided by the total project cost. So your net operating income is your revenue minus expenses before debt, right? Before you're paying down your loan at all, but it's revenue minus expenses. That's your NOI. And then taking that over your total project cost, we want that number to be higher than 7%. That means out of the gates, the cash on cash, the cash flow should be good to the investors, right? And we should be in a better position to potentially refinance. We're at a better position to position ourselves for sale as well. A lot of good things go along with that 7% number. That's kind of the benchmark we're seeing in the market right now. Aside from this, we like to see market occupancies that are high. Makes a lot of sense. We don't want to be developing in an area where the market occupancy is 65% because adding more units isn't going to solve any issues and our rents probably aren't going to be achieved. Aside from that, limited supply, pent-up demand. And then with all multifamily development, we're targeting a TIF incentive right now. It's just the only way to make these deals pencil. And the communities that you see offering these TIFs are the ones that are growing right now. So we've been lucky to have some great project partners in Oak Creek, in West Bend, in Brown Deer, and now in West Dallas as well, where we're able to see some benefits from these TIF incentives and help pencil these projects.
Absolutely. So while Lane touched on what we're looking for in these multifamily developments, which is great, we're going to run through a quick case study of a deal that is going full cycle. So 134 units we developed in Brown Deer, Wisconsin, in 2021. It was fully delivered in June of 2022, and we reached stabilization shortly after that in November, December of 2022. We then did a very accretive, nice refinance, moving to a 10-year loan with Freddie Mac, and we were able to return all of the accrued preferred return, which we'll get into. On this deal, 7%, and then 20% of the invested capital. And through that optimized refinance, we're able to reduce our interest rates from the construction loan to the permanent loan, maximize our cash flow, and then get to a normal distribution cycle where we distribute quarterly. So we've been distributing every quarter. We've been producing fantastic cash flow, well above 13-14% cash on cash. And now we've looked to exit that project, which we officially have under contract and are looking to sell later this year. And you can see the investment thesis as we initially projected. Our target metrics were met. We're looking at close to a 19% limited partner IRR for our investors over that whole period, as well as an equity multiple of about 1.9 times your original investment. So on this deal, a $100,000 investor would receive about $190,000, just shy of that. So that's a great case study. And as Lane mentioned, we're doing that right now in West Bend, in Oak Creek, Brown Deer, and really excited about jumping into this 92 project, which meets all the parameters of what we're talking about today.
Yeah, awesome. So let's get into F Street 92 LLC, Axis Apartments. You may have heard us talk about it, but it's our next multifamily project that we'll be breaking down on this year. So let's talk about what it is real quick. It's located in West Dallas, Wisconsin, which is a western suburb of Milwaukee. We're doing a ground up development there, so 147 market rate apartment units. The first phase is going to be 2 garden style buildings, each consisting of 21 units. And then the second phase will be 1 mid-rise building, which is 105 units right now. We're looking to do this all as one project, phased separately, but all under one roof, right? So the projected budget is looking to be about 38 million. And then we're expecting the full project delivery in the third quarter of 2027. Those metrics could change just a little bit, but I think we'll be delivering right around then.
Yeah, and the advantage of the garden style apartments, the 42 apartments via the 2 garden style apartments, that would start construction this November.
Yep.
And that would deliver next year in 2026, the 2 buildings.
Yep.
So the nice part about the project is we're into the income stream, meaning we can lease and generate income, call it Q2, Q3 of next year.
Yeah.
And then the mid-rise apartments, the 102 units, don't break ground until
March of next
year, and delivery, like Lane said, in 2027. So it's a nice phased project. It's one overall project on one site, but the phased delivery allows us to continue to receive rental income, continue to manage our cash flow and our interest reserve as we get to a fully leased, is what we like to call stabilized multifamily asset.
Yeah, we really like the options that we'll be able to give tenants in these buildings. So in the garden style, you have slightly larger units, you have the attached garages that our tenants can take advantage of. But in the mid-rise buildings, you have a little bit more of the closer amenities. You have a great rooftop deck here that you can see. It's beautiful. Fitness center, lounge area. Some garden style tenants will have access to a few of those amenities, but really we have a nice contrast between kind of the more pseudo single family home living style versus the apartment living style, and tenants will have that option to take advantage of either.
Definitely.
Yeah, so go ahead.
No, you can go into the target metrics.
Yep. Yeah, so we talked about our target metrics earlier. We want to hit 18 to 23, 25% IRR, the untrended yield on cost and equity multiple we discussed already. But to compare that to what we're projecting for F Street 92, we're checking that box, 20% plus IRR. Our untrended yield on cost is up to 7.5%, which is fantastic. It's hard to achieve that in the market today. And then our equity multiple over a 4-year period is projected to be 1.97x. So you invest $100,000, we project that over the course of the next 4 years, we can distribute to you $197,000, which is $97K of profit, almost doubling your investment. So this is based on a 4-year hold, and it's also based on a 5.7% exit cap rate. Now, if you're tuning into our presentations or if you're in the real estate world, you probably hear cap rate quite often. And just in case you don't know exactly what the cap rate is, it's the building's net operating income divided by the price of the building, the acquisition price, right? So the lower the cap rate, that means the lower the NOI is compared to the price. So newer Class A buildings will have a lower cap rate, and the older buildings, maybe not in a great market, will have a higher cap rate because the NOI is greater compared to the total price in those scenarios. So we're basing it at a 5.75% exit cap rate in year 4, which we believe is a little bit conservative compared to market. We'll show you in a slide or two here.
And why this is so important too is if we can develop here, right, and we can refinance once we're stabilized between month 24 and month 30, once we're built and leased, and the market comps are between 5.5% and 6%, that projects a value higher than our development costs. And we'll get into that value creation that we're creating, which is ultimately equity in our pockets and our investors' pockets day one. And then as we work to increase revenue over the whole period, manage our expenses, increase our net operating income that Lane talked about, right? And then eventually exit this for a cap rate lower, projecting a higher value, that equates to profit for F Street 92 LLC and its investors.
Yeah, it's all one big equation.
Exactly.
Yep.
So this kind of touches on, a few sales comps in the recent years in a slightly different economic environment. And then we also have some benchmarks on pricing of where we believe what type of cap rates these types of newer multifamily assets would trade at. So we always look at everything in the current economic climate, understanding that things are dynamic and changing. We don't have the crystal ball.
Yep.
So we run a sensitivity analysis to say, If it sells at a 5.25 cap, all the way up to a 6.25 back, 6.25 cap rate.
Football season's coming up, quarterback. Yep.
That's right. Thank you. 6.25 cap. What does that do to our valuation of the property? And then looking at that compared to our overall development cost. And here you can see a chart of, hey, what is the valuation at a 5.25 cap all the way up to a 6.25 cap? And what does that produce in terms of value creation, which is ultimately profit, right?
Yep. It's really the base of it is the price that we're selling it for based on what we built it for.
For sure.
That's that value we're creating, and that's what is such a great thing about development. We're not really going to do that in an industrial acquisition. It's possible, right? But the value creation that you have, the ability in multifamily development or industrial development is so great if you have the right project partners, if you underwrite correctly, if you manage the building well. And we believe we do all of those very well, and we're going to be able to create this value that we have, like we have in Greenlink, as we detailed earlier in other projects. But as you can see here, the cap rates that these buildings sold for in the last couple of years are lower than what we're projecting here. So 5.75 is our base cap rate assumption, right? And if we trade closer to, say 5.18%, we're going to create almost more than $4 million of added, increment to ourselves and to our investors. That's just going to boost profits for everybody. So we like to think we underwrite conservatively, and you can see that compared to market transactions. But yeah.
Right. And we know that, we review, are involved in a lot of, evaluating a lot of opportunities and a lot of sponsors and look at other investments. And, it's easy to manipulate numbers, right? It's easy to not underwrite conservatively, right? And sell equity. That's not our goal here. Our goal is to provide market-driven assumptions, which is what we do. And then we have a sensitivity analysis so we can say, hey, if we sell it at X, Y, and Z, does the project still make sense? And the answer is, in this project, due to the 27-year TIF, due to the market, due to the product that we're building and our overall economic package and site plan, the answer is yes. We're super excited because of all these different items that check our boxes and what makes us excited about developing a multifamily project.
Yeah.
So a little bit about depreciation. Do you just want to touch on it quickly?
Yeah, so if you're curious about depreciation, I would urge you to go to our YouTube channel and check out the video we did on this last week. We did a half hour just solely on depreciation. But essentially with the projects that F Street offers to our investors, as long as they're not an extremely short-term hold, which hardly any of them are, you'll be able to take advantage of some depreciation benefits, which derive from us completing cost segregation studies and accelerating depreciation, and there's bonus depreciation, right? But really what it comes down to is at the end of the day, you can defer your taxes to a later date. You can make sure you're not paying the short-term capital gains taxes. You can defer those into long-term capital gains taxes at the end of the day. So investing in real estate, especially multifamily development, can really help you capture benefits from that.
And the nice part about the cost segregation studies that Lane alluded to is a lot of the 5, 7, 10-year property, which has a shorter expected life per the IRS code, it allows real estate investors to deduct that wear and tear on a shorter time frame, right? So that accelerates the depreciation forward, right? Yep. So we work closely with our project team and our third-party accountants who perform these cost seg studies to ensure that we can deliver and maximize our depreciation to ultimately offset or create passive income to ultimately offset your passive income, right? Yeah. So we are excited about the opportunity here, which will be performing a cost seg study to help you minimize your taxes. Ultimately, when we go to sell it, there's some recapture per the IRS code, 1245 and 1250. But ultimately, that takes down your effective tax rate on the investment, and it's super beneficial for us to conduct these studies and ultimately pass it through to you, the K1 investor in these deals.
Even if you were to pay the same total tax dollar for this investment over the course of 4 years, it's much better to pay it 4 years from now than it is to today, just because of time value of money. You have more money in your pocket today, they're able to invest in other securities, alternatives, whatever it might be.
Absolutely. So we've talked quite a bit about the TIF. We've talked about the relationship in the leadership of West Allis that we've worked diligently as a part of our team to get the 27-year 100% of the taxes paid for, which we are very close to having formalized. The city also provided a $1 million loan for us, right, as part of the overall project. Yep. To help us get through the acquisition and demolition, which will be paid back once we close on the investment as well. Yep. So 27-year TIF, super powerful. We've talked about it. 100% of the increment, meaning the taxes that we're providing to the city, are rebated back to us. So we are not paying property taxes during the duration of the TIF. So super powerful for the investment.
Yep, definitely. So here are just a couple renderings of the buildings. So you can see the mid-rise buildings here, a little bit of the garden style back in the northeast corner. And then this building right here is Gonzaga Senior Living. It's just a senior living facility, that separate property, but it is right next to our podium building. We're neighbors. So it's great. Here's some renderings of the interiors. Here's what the kitchens will look like, right? We have stainless steel appliances. We have some lounge areas here and here, and we'll have a great fitness center as well. That's just a fitness center image from, Josh, do you know which property that is? One of our existing properties.
Believe that's Greenlink.
Greenlink, Brown Deer. Awesome. Oh, go ahead.
Yeah. So as we put together our overall capital stack, the nice part about this opportunity is we already have a term sheet from a local lender that has been a construction lender for us in the past. We've got a great relationship and excited to execute on that term sheet.
Yep.
We have a interest-only period to get us through the construction and lease up, and ultimately get us to that refinance that we've talked about once we're fully stabilized. So this just highlights our debt on the sources side and the equity. We put in capital, our partnership team puts in capital, meaning our project team, and then we syndicate the rest of the equity across you, the investor, which then highlights and pays for all the uses of funds. And you can see there's an acquisition component, there's construction and hard costs that always make up the vast majority of our development projects. And then we have other soft costs and fees for our architects and contractors. We have reserves built in, right, to get us to a lease up as we're paying interest on our loan. We have an interest reserve. So all these different things are very typical in all of our developments. So this is a nice summary of sources of funds, debt and equity, uses of funds, and how we're paying for, how the debt and equity pay for all these different uses of funds that we itemize out here. If you have any questions on this or anything else, feel free to ask, or we're happy to hop on a call today, tomorrow, or if you have any questions next week.
Yeah, one really nice thing that I think Josh touched on earlier about these projects being phased is that the revenue from the garden style will help to lower our total reserves, right? Because you have to have reserves built into your upfront budget to be able to cover, expenses and debt while you're not fully leased up. So the garden style will help take care of all of those expenses that the mid-rise would normally have. So that keeps our budget lower than it would be in the first place.
Yeah, and just as another follow-up to that, which is a great point. I mean, as we look at market rate assumptions in terms of interest rate, cap rate, we know our costs, right? Because we work with this contracting team before and our architects. Lane, just kind of a little bit behind the curtain, right? When we look at our interest carry, we look at our lease up schedule, we have, a model that based on conservative expectations, how much interest we need each month as we're getting to, right, that fully stabilized asset, right?
Right.
So we know the income coming in based on projections that are conservative, and we know our interest reserve and how those offset each other. And like Lane said, that helps keep our project costs down, but while not being too aggressive, right? Because we'd rather have a excess cash at the end of the day where we can return to our investors or pay down our loan than not have enough to get us through that fully stabilized multifamily asset.
Right. It's not just like the extra that we don't use goes to our pockets, right? It goes back to the investors. So at the end of the day, we usually account for 4 to 6 extra months of reserve than we think will actually be needed. But anything that we don't use just goes right back to you. So it's great.
Investment structure.
Yep. So it's our normal investment structure. We won't spend too much time on this, but an 8% preferred return to our investors. Then 100% of free cash flow goes to you until you're fully recapitalized, meaning your preferred return is paid down and we've paid back all of what you invested initially. Only after that point does the split occur where investors receive 60% of cash flows and F Street receives 40% of cash flows. The reason we do this is because it keeps it really simple. It motivates us to get you your capital back, pay your preferred return as quickly as we can. Otherwise, we don't make any money, which we are investor focused. We want you to come back. We want you to be successful in every deal that we do. But at the end of the day, we're a company. We have to make money too, right? But this just incentivizes us to return cash flow as quickly as we can to you. There are other much more complicated structures out there like IRR waterfalls, which I think don't have investors' best interests in mind always. Something like this is super straightforward. I love that we do this and it's easy to explain to our investors. Right?
Absolutely, yeah. And the goal is to always, the company was founded by Scott years ago and he always had the simple principle of take care of the investors first, right? The goal is to mitigate risk across the spectrum, but also for the investor, and pay down that capital to de-risk the investment until we are in the money and we're sharing in the upside with the investor. So that we try to keep the model simple. So a little bit about the timeline, right? Currently, this investment, Access Apartments, is open for investment right now. We're about 40% raised and in active conversations to secure additional capital. The goal is to have all the capital fully funded by October 31st, which would get us to a closing that first week of November on our construction loan with the bank. We would start construction on the 42 units in November, shortly after that. And as Lane mentioned, we will be phasing that project. So those 2 buildings, 42 units, would be delivered in Q2, Q3 of next year, 2026. March of next year, we'll be starting the stickover podium, the 102 units. So there'll be a phased delivery, and that will deliver about a year after that in 2027, as you can see here, Q2. We'll be targeting a refinance once the asset is stabilized on a higher appraised value and reduced interest rates with a better execution than our construction loan, as that investment has become de-risked and less risky for a future lender to take out the construction lender, put permanent debt on it, optimize cash flow. And then we get into this stabilization cycle where we have a stabilized budget. Distributions happen quarterly and regularly with a predictable schedule. And then we're showing here a Q4 2029 sale. Now, we penciled this out like this, depending on where capital markets are, depending on where our refinance execution, and depending what things look like. This might be delayed 6 months, a year, 2 years, but the goal is really a 4 to 7 year hold period, right?
Yeah, for sure. And if somebody comes along right after we stabilize and offers us a price that's too good to deny, then we'll take that too. So it could happen in a large range. That's just the game with real estate, and we are subject to the market, right? But we're going to do our best to time it as best as we can for our investors.
And what's nice about our model is we don't have a fund where we're forced to sell something based on a certain time frame. We want to sell in a favorable economic environment with lower cap rates, right, and a higher valuations to maximize our profits and proceeds for the investors and boost returns. We don't want to be forced to sell just based on a 4-year hold if it's not an advantageous time. Maybe there's additional work on the revenue side and expense side that we see that we can manage and get to a better net operating income number in year 6, year 7, and it's more favorable, and our profits are boosted despite being 2 or 3 years behind that 4-year target.
Yeah, here a few more renderings in here, and that's all we have. So I think that's it for today. But if there are any questions, we'll stick around here for another minute or two. And if you have questions that pop up later, please feel free to reach out to me or Brian. So my email is lane@fstreet.com. Brian's is Brian with an I at fstreet.com. And we'll be happy to help reply to your email, hop on a call, whatever we can do to help you answer your questions. So thank you all for your time today. We appreciate it.
Thank you for your time today. We appreciate you joining us. If there are any questions, we will stick around here.
All right, we did have a question. The question was, how is the TIF negotiation going? So I saw in my email that we were sending back red lines today on our development agreement, which contains the TIF agreement as well. And it's going really well. I have to give kudos to the city staff of West Dallas. They really are first class and one of the best to work with. So we're going back and forth with them, but there's no indication that this TIF agreement won't happen. So hopefully that answers your question. Yeah, for sure. So the question was, when will we start to see return on this investment? So the answer is 20 to 24 months out is the projection. So we do have a lot of construction here. We have 16 months total of construction at least, right? And then we also have to lease up the buildings after that. So we're hoping that the lease up is quick, especially with the garden style. We believe that we'll lease up those 42 units relatively quickly, with the mid-rise lagging about 8 months or so. We don't need to be 100% stabilized to start distributing cash flow, but we'll start looking at distributing small cash flows or potentially a refinance execution at full stabilization in roughly months 20 to 24.
Yeah, and I always like to say as a general rule of thumb to be conservative, when you invest in these types of opportunities, right? Getting to a fully stabilized asset with a strong NOI allows us to get to that refinance at a higher valuation, right? maximize our proceeds while not over leveraging the asset. So I think the goal here as a general rule of thumb, I always like to be very conservative, say about 24 months.
Yep.
And we're excited about executing here. We do a Tracy Cross market study, right? That helps us outline the unit mix, square feet, amenities, also rents, right? So we have a good idea of the absorption and where we can get to our refinance once we're fully stabilized.
Yep. Awesome. Thanks for the
Okay.
question.
Thank you, everybody. Appreciate it.